Have you ever thought about how a farmer hundreds of years ago would trade a bag of wheat for a bale of cotton? This simple exchange was known as the barter system. While it worked for a while, people faced big problems because they could not easily divide things like cattle or transport heavy goods over long distances. To solve these issues, the world needed a common way to measure value, which led to the invention of money. As people looked for a better way to trade, they turned to something shiny and durable like metal coins. Gold and silver became the top choices because they were easy to carry and everyone accepted them. Eventually, this led to the gold standard around 1870. Under this system, countries valued their currency against gold reserves. For example, if 1 unit of gold was worth 10,000 rupees or $500, the exchange rate became $1 for every 20 rupees. Building on that trust in gold, we eventually moved toward paper money. At first, this was just a promise that the paper was worth a certain number of coins held in a bank. Later, between the years 1944 and 1971, the world used the Bretton Woods system. This was a mix of the gold standard and floating rates, where most currencies were tied to the US dollar and the US dollar was tied to gold. This system helped create the IMF and the World Bank while making the US dollar the most dominant currency. Now that we understand those old rules, let's see what happened when that system fell apart. By 1973, the Bretton Woods system collapsed and gold was no longer used as the common anchor. This led to the rise of the modern forex market, where exchange rates are determined in real time by information flowing through the world. While developed countries moved to market determined rates, many developing nations chose to peg their currency to others or use a managed system. Since we moved away from gold, you might wonder what actually gives our money value today. Most modern money is called fiat money, which is issued by a government and is not backed by a physical commodity like silver. Its value comes from supply and demand. And how stable the government is, we often see two types of exchange rates here. A clean float, which is purely market driven, and a dirty or managed float, where a central bank like the RBI intervenes to stop the price from swinging too wildly. Moving forward, let's look at the specific brands of money that dominate this global marketplace. We use the ISO 4217 standards to give every currency a 3-letter code. The biggest ones are known as the majors, which include the euro, the US dollar, the Japanese yen, the pound sterling, the Australian dollar, the Canadian dollar, and the Swiss franc. These currencies all use a free floating method to decide their value. Now that we know the currencies, we need to see how they are traded in pairs. A currency pair shows the value of one unit against another. According to a survey from April 2022, the most active pair is the euro versus the US dollar, which makes up 22.7% of all trades. Other big pairs include the US dollar versus the Japanese yen and the pound sterling. Interestingly, the pair for the US dollar and the Indian rupee accounts for 1.6% of the global turnover. While the majors get most of the attention, there are other groups of pairs worth knowing. Minors or crosses are pairs that do not include the US dollar, like the euro versus the British pound. Then we have exotic pairs which combine a major currency with one from an emerging market like the US dollar versus the Turkish lira. These exotic pairs allow traders to explore markets in places like Asia, Africa, and the Middle East. Building on the idea of trading pairs, let's explore why the US dollar is the undisputed king of the market. It is used as a vehicle currency, which means instead of trading two rare currencies directly, people trade them both against the dollar first. This makes the market much more efficient. Without a vehicle currency, 100 different currencies would require 4,950 different pairs. But with a vehicle like the dollar, that number drops to just 99 pairs. Now that we see its dominance, let's look closer at the other big players like the euro and the Japanese yen. The euro is the official currency for 20 out of 27 members of the European Union and is the second most traded currency in the world. The Japanese yen holds the third spot. It is very liquid and is a favorite for hedge funds who use it for carry trades because it is available around the clock. Let's continue our tour with a look at the British pound, the Swiss franc, and our own local currency. The British pound is often called the cable, a name that comes from the old telegram wires used to send rates across the ocean. The Swiss franc is known as a safe haven because the Swiss government is so stable. Finally, we have the Indian rupee, which uses a managed float. The RBI steps in to trade whenever they need to ensure the exchange rate does not become too volatile. With participants from every corner of the globe, the currency market never truly sleeps. It operates on a 24-hour cycle as financial centers in London, New York, Tokyo, and Mumbai overlap their business hours. The market is at its busiest when both Europe and the United States are open for business. This continuous flow provides a real-time assessment of prices and allows traders to react instantly to any unexpected global events. Now that we understand the timing, let's look at the massive scale of these operations. The Forex market is a decentralized OTC marketplace, meaning it does not have one single central location. It has grown incredibly fast as international trade has expanded. By the year 2020, the average daily turnover reached a staggering $7.5 trillion. This makes it by far the largest financial market in the entire world. To wrap up, let's see which financial tools are driving this incredible volume. Most of the trading happens through foreign exchange swaps, which account for $3,810 billion every day. Spot transactions where trades happen almost immediately come in second at $2,104 billion. We also see significant volume in outright forwards and options, showing just how many ways there are to participate in this global exchange.